In our last journey together, we explored The Willpower Instinct by Kelly McGonigal, a fascinating guide to mastering self-control, overcoming temptation, and aligning your actions with your goals. But today, we're turning the page to a completely different battlefield, the financial markets. Welcome to a random walk down Wall Street by Burton G. Malkiel, a timeless classic in the world of investing. This isn't just another book about stocks, it's a reality check for anyone who believes they can consistently outsmart the market. Malkiel takes us on a tour through centuries of market history, legendary bubbles, Wall Street strategies, and cutting-edge financial theories, only to challenge one fundamental question: is it even possible to beat the market, or should we simply ride along with it? In this video, we'll explore its most eye-opening lessons, and reveal the practical investment strategies it offers for beginners and seasoned investors alike. Whether you're looking to build long-term wealth, avoid costly mistakes, or simply understand how the market really works, this deep dive will give you the knowledge to walk Wall Street with confidence.
Part 1: Stocks and their value. The first part of the book lays the foundation for understanding how stocks are valued and why markets move the way they do. Malkiel introduces the two main schools of thought: intrinsic value analysis and speculative psychology. He blends historical context with human behavior to show how crowd sentiment can disrupt logical pricing. Readers learn that both solid fundamentals and irrational manias influence markets. This part sets the stage for recognizing why predicting short-term market movements is so difficult. Chapter 1: Firm Foundations and Castles in the Air. Malkiel begins by presenting the firm foundation theory, which states that every stock has an intrinsic value determined by a company's financial performance, earnings, and dividends. Investors using this approach try to buy when prices are below intrinsic value and sell when above. He contrasts this with the castle in the air theory, where value is based on what others will pay, essentially driven by market psychology and speculation. Both theories have merit but also serious flaws. Fundamentals can be miscalculated, and crowd moods can be wildly unpredictable. Through examples, Malkiel shows that investors often mix both approaches without realizing it. This chapter warns that neither theory can fully protect investors from volatility. It sets up the rest of the book by showing the tension between logic and emotion in markets. Chapter 2: The Madness of Crowds. This chapter explores history's most famous speculative bubbles, such as the 17th century Dutch tulip mania and the South Sea bubble. Malkiel demonstrates how entire societies can become obsessed with an asset, driving prices to absurd levels before a dramatic collapse. These episodes show that herd behavior and greed can overwhelm rational valuation. He explains how fear of missing out lures investors into buying at unsustainable highs. The key lesson is that market psychology is powerful enough to defy logic for long periods. Malkiel emphasizes that investors must be cautious, as history shows these manias occur repeatedly. By understanding crowd dynamics, readers can better protect themselves from financial euphoria and panic. Chapter 3: Speculative Bubbles from the 60s into the 90s. Malkiel moves into modern times, reviewing speculative frenzies around growth stocks, conglomerates, and biotechnology companies. He notes how concept stocks captured investor imaginations, with their potential exaggerated by media hype and analyst optimism. Many of these companies were valued far beyond realistic earnings expectations. The cycle was predictable. Excitement builds, valuations soar, reality disappoints, and prices crash. He shows that even professional investors often join the mania, driven by pressure to keep up with market trends. This chapter reinforces the idea that human psychology, not just economic fundamentals, drives market cycles. It also builds the case for skepticism toward hot sectors. Chapter 4: The Explosive Bubbles of the Early 2000s. Here, Malkiel analyzes the dot-com bubble of the late 1990s and the housing market bubble of the 2000s. The internet boom saw companies with no profits valued at billions simply for being part of a new industry. Investors believed the rules of business had changed, but when reality hit, trillions in wealth vanished. The housing bubble was fueled by easy credit, speculative buying, and belief in endlessly rising property prices. When the bubble burst, it triggered the 2008 global financial crisis. Malkiel uses these examples to show that even in a modern, information-rich world, irrational behavior persists. The takeaway: markets may self-correct, but they can stay irrational long enough to cause great harm.
Part 2. How the pros play the biggest game in town. In this section, Malkiel examines the two dominant professional investing approaches, technical and fundamental analysis, and tests their ability to beat the market. He shows that both have passionate advocates but mixed results in practice. The evidence suggests that neither consistently outperforms a simple, low-cost index strategy. He also introduces the efficient market hypothesis, EMH, which argues that stock prices already reflect all available information. This part challenges the notion that expertise alone can produce superior returns. Chapter 5: Technical and Fundamental Analysis. Technical analysis focuses on price charts, patterns, and market statistics, while fundamental analysis looks at company financials, industry trends, and economic conditions. Malkiel explains that technical analysis assumes past price movements can predict future trends, while fundamental analysis seeks to estimate a stock's intrinsic worth. He notes that both methods face flaws. Technical patterns can break down, and fundamental estimates often rely on uncertain forecasts. Furthermore, both are vulnerable to human bias. While these tools can provide insight, Malkiel warns against relying on them as foolproof profit-making systems. Chapter 6: Technical Analysis and the Random Walk Theory. Malkiel explores the random walk theory, which argues that stock price movements are unpredictable and follow no reliable patterns. He dissects popular technical tools, trend lines, support levels, moving averages, and shows that while they may seem to work in hindsight, they often fail in real time. Studies reveal that price changes resemble randomness more than predictability. He also humorously notes bizarre predictive systems, such as the hemline index, to show how people seek patterns in noise. The core message: investors should accept market unpredictability rather than try to outguess it with charts. Chapter 7: How good is fundamental analysis? Turning to fundamental analysis, Malkiel evaluates whether deep research into companies can reliably produce above-average returns. He presents evidence showing that professional analysts and mutual funds, on average, fail to beat market indexes over time. The efficient market hypothesis suggests that once information is public, it's already reflected in prices, making it hard to gain an advantage. Even private or inside insights tend to lose value quickly. Malkiel concludes that, while fundamental analysis can help avoid obvious mistakes, it's not a magic bullet for outperformance.
Part 3: The New Investment Technology. This section introduces modern portfolio theory, MPT, risk-return optimization, and behavioral finance. Malkiel explains how diversification and statistical models can improve investing outcomes, but also why no formula can eliminate uncertainty. He presents innovations like smart beta and risk parity, while cautioning against assuming these strategies are foolproof. This part blends mathematical theory with human behavior to provide a balanced perspective on modern investing tools. Chapter 8: Modern Portfolio Theory. In Chapter 8, Malkiel introduces modern portfolio theory, MPT, revealing how combining assets with differing correlations can reduce overall portfolio risk, often more effectively than holding individual stocks, even when each asset carries volatility. He explains the concept of the efficient frontier, where investors can seek the highest possible return for a given risk level. Incorporating risk-free assets further reshapes the frontier via the capital allocation line, enhancing optimal portfolios. MPT's mathematical foundations underscore that diversification, not stock picking, is key to managing risk. While powerful, MPT relies on historical data and assumptions that may not always hold in dynamic markets, reminding readers that theory and reality sometimes diverge. Chapter 9: Reaping Reward by Increasing Risk. This chapter delves into how risk relates to expected return, centering on the capital asset pricing model, CAPM, which links higher expected returns to greater systematic risk, beta, that cannot be diversified away. Malkiel explains how unsystematic, company-specific risks can be eliminated through diversification, leaving only market-wide risk to be rewarded. The chapter also acknowledges extensions to CAPM, such as the Fama-French three-factor model, which adds size and value factors to better explain return variations. Yet, even with these refinements, models like CAPM and APT, arbitrage pricing theory, have practical limitations when applied to real-world investing. Chapter 10, Behavioral Finance and New Theories. Here, Malkiel explores behavioral finance, examining how psychological biases like overconfidence, herding, and loss aversion lead investors astray and contribute to market anomalies. He introduces smart beta and alternative strategies that try to systematically exploit factors like momentum or low volatility, but warns that these are often overhyped and may not consistently outperform. Despite market inefficiencies, human behavior tends to reinforce efficiency over time. Understanding behavioral pitfalls empowers investors to resist emotional decision-making and recognize that complex models cannot fully eliminate bias.
Part 4. A practical guide for random walkers and other investors. This final section applies the book's lessons to real-world investing. Malkiel gives clear guidance on building a portfolio, planning for different life stages, and managing risk. He stresses the importance of low costs, disciplined saving, and sticking to a long-term plan. By combining indexing, diversification, and realistic expectations, investors can maximize their chances of success without trying to beat the market. Chapter 11, A Fitness Manual for Investors. Malkiel emphasizes that before venturing into investments, individuals must first build a strong financial foundation. This includes creating an adequate emergency fund, eliminating or managing high-interest debt, and securing essential insurance coverage. He warns that failing to address these basics exposes investors to unnecessary risks that can sabotage long-term goals. Tax efficiency plays a vital role, as excessive taxation can eat into returns just as high management fees do. Malkiel champions low-cost, diversified portfolios, particularly index funds, as the backbone of wealth building. He discourages speculation or market timing, urging consistent contributions regardless of market conditions. Patience, discipline, and emotional control are essential to avoid impulsive decisions. Avoiding unnecessary complexity in investments helps maintain clarity and direction. Ultimately, financial fitness is about combining preparation with disciplined execution, making success more likely and sustainable over decades. Chapter 12, Projecting Returns. Malkiel offers a practical framework for estimating long-term investment returns using three main components: dividend yield, dividend growth, and changes in the price-to-earnings (P/E) ratio. Dividend yield can be directly observed, while growth estimates are based on corporate earnings retention and reinvestment strategies. P/E ratio changes are less predictable and often cause short-term market volatility, but their effect fades over decades. He explains that in the long run, dividends and earnings growth dominate overall returns, making them crucial for realistic projections. For bonds, expected returns align closely with prevailing interest rates. Understanding these elements helps investors set reasonable expectations and avoid disappointment from over-optimistic forecasts. While forecasting is never perfect, using this disciplined approach improves planning accuracy. This method encourages focusing on fundamentals rather than daily market noise. It equips investors to think long-term and prepare for varied market conditions. Chapter 13, Life Cycle Investing. In this chapter, Malkiel outlines how investment strategies should shift with age and changing financial responsibilities. Younger investors are advised to hold a larger proportion of stocks, taking advantage of growth potential and time to recover from downturns. As individuals approach retirement, the allocation should gradually shift toward bonds and safer assets to protect accumulated wealth. This transition should be planned, not triggered by short-term market events. He stresses diversification within each asset class to reduce risk further. Life cycle investing also considers personal circumstances such as job stability, health, and family obligations. Malkiel emphasizes the importance of rebalancing portfolios periodically to maintain the desired risk profile. Adjusting strategy over time helps align investments with evolving goals and risk tolerance. This approach ensures growth in early years and stability in later years, creating a balanced wealth journey. Chapter 14, 3 Giant Steps Down Wall Street. The book closes with Malkiel summarizing 3 core principles for long-term success. Invest in low-cost index funds, diversify broadly, and minimize all costs and fees. He argues these simple steps often outperform most actively managed strategies, especially over decades. Diversification should span not just industries but also countries, asset types, and company sizes. Keeping costs low ensures that more of the investment's growth stays in the investor's hands. Emotional discipline is equally important. Resisting fear during downturns and greed during booms preserves wealth. Malkiel warns against overconfidence, market timing, and frequent trading. Instead, he promotes a steady rules-based approach to investing. Accepting the market's randomness, rather than fighting it, provides peace of mind. By following these steps, investors can create resilient portfolios capable of weathering any market cycle while steadily building wealth.
The conclusion reinforces Malkiel's core message that markets are largely efficient and unpredictable in the short term, making active trading a losing game for most investors. Instead, long-term wealth is best built through disciplined investing in low-cost, diversified index funds. He emphasizes the importance of patience, consistency, and resisting emotional reactions to market fluctuations. Risk should be managed according to life stage, with gradual portfolio adjustments over time. Costs, taxes, and unnecessary complexity must be minimized to preserve returns. By accepting the market's randomness and focusing on what can be controlled, investors can achieve steady growth. Ultimately, simplicity, discipline, and time are the most reliable allies for financial success. In closing, a random walk down Wall Street has shown us that financial success is less about chasing trends and more about disciplined, informed investing. The strategies shared remind us that patience, diversification, and a long-term mindset can outperform even the most sophisticated market timing attempts. As we conclude this journey through the complexities of the market, remember that lasting wealth comes from steady progress, not quick wins. In our next video, we'll shift focus to a powerful productivity guide, The One Thing by Gary Keller, where we'll uncover how mastering focus can transform your results in work and life. Stay tuned, because the lessons ahead may just change the way you approach your goals forever. Thank you for watching the Empowerment Library. Remember to like, share, and subscribe so you never miss the wisdom that can shape your future.